right, welcome everybody to the live training session. Today is Wednesday, October the 31st, 2018. It's about 7 minutes after 2 p.m. Eastern Standard Time, and I wanted to have a quick training session, answer any questions that you have. I thought today would be a perfect example to go over last night's pulse waves that you received. All right, most notable is the NASDAQ 100 futures, which is what you see on the screen. This this part right here, the top chart, is the weekly chart. This one on the down on the left-hand side here is the daily chart. This is the 4-hour chart here, and then over here is your 1-hour chart. All right, so what we had was a rally alert that you received last night. Those reports go out at night after the markets close. I wait for the futures and the Forex markets to close out for their daily sessions. Then the exchanges allow me to receive the data. I know some of you are thinking, yeah, but don't futures, some of the futures contracts, and especially Forex, doesn't it trade 24 hours a day? So there's really not a close. Yeah, that is true per se, but around 5 p.m. Eastern Standard Time, it is a universally accepted phenomenon where a lot of the Forex brokers, things of that nature, they close out the daily session, and then around 6 p.m. Eastern Standard Time, it is globally accepted that that starts the next day's session. So they actually provide you data based off of that, for those that don't know that. All right, what else? So we got the rally alert last night, and if you remember, for those of you who watched last night's video, if you have not done so, go ahead and bookmark that. It's uploaded on YouTube. You can go ahead and peep that. You see what we had, the rally alerts. I was showing you the past rally alerts leading up to the last signal that we got, and what the markets have done leading up to that point. The purpose of today's video, though, is we're going to be looking at how to time your entries and how to time your exits. We'll be looking at entries and exits. Entries, for the most part, is the easiest part. The exits is subjective, to be quite honest. There's no cut and dry set formula for exits. Exits can be based off of any numerous things. Because I have experience in doing this for so long, for myself, I use the price triggers for everything, in and exit. But I use mostly the 2-bar Charlie method to time my exits. I look at the market depth. I look at how the price action is moving. I read the tape, and that lets me know how the market is moving and what the threat level is based on market depth. So I take a look at the order flows. I see where people are putting their stops, and then I like to run those stops. That's how I enter a position. The price triggers are designed to run other people's stops. You know, people always complaining, man, I don't like putting stops in because, you know, they're going to come in there and they're going to run your stop, and then the market's going to, you know, move in the direction you wanted to move without you. Some of that is true. I can't deny that. Some of that is true. But I designed the system to be the bully and not the one being bullied. So I'm running the institutional stops. That's what I'm doing. That's what the price triggers do. They enter the market where the institutional money is hiding. All right. And we live in an age now of technology, extreme technology. The large institutional monies, the banks, etc., they have very sophisticated, high-frequency trading machines that are running 24/7. These machines can execute millions of trades a day. thousands per second, and they can be in and out of a market. And if enough machines enter the market at the same price level, that's what moves the markets. And depending on how thinly traded a market is, it can cause a fast market environment. For those of you that have followed me for some time, you've heard my other videos on YouTube explaining certain market phenomenons. We've talked about fast market before. I realize that some of you are new, so I will touch on that quickly. A fast market is when there are more orders entering into a certain market well above average. Case in point, I like to use this scenario because it's a real life scenario that happened to me. And one of my buddies over on YouTube, you've heard me talk about it before, those who've been with me for a while. We laugh about it even to this day, where there was a military coup in the Ivory Coast, and that's where the majority of the world's cocoa is manufactured, grown, shipped out. So it made the cocoa market go berserk. The cocoa market back in during these times was a very thinly traded market. All right. In the 90s, you could expect back in the 1990s for cocoa, on a good day, on a high volume day, it may do, a couple of hundred contracts a day, and if there was really something going on, you may get 2,000 contracts in a day. All right. That was considered, busy, Well, on this particular day, they got an excess of 20,000 contracts almost instantaneously, with more coming. And it's a small little pit, so it's not a whole lot of brokers in that pit. And on this day, I mean, they're getting, if my memory serves me correctly, I think they got over like 110,000 orders or something like that. So, floor brokers, man, going home with tickets in their pocket, and it didn't matter if you placed a stop order or a limit order or a market order, you were not guaranteed to fill. Not on that day. That's right. I had a market order, and it took me like a week before I got back some kind of, you know, price. And at the time, they were like, "Nope, you still don't have a price for you. I don't think your order got executed." So it was crazy, man. It was just bananas. So when a lot of orders come in, especially large institutional orders, back then you didn't have the internet. Now you have not only the internet, but you have high frequency trading machines. So imagine if that happened today, it would just, the machines would just blow up. Back then too, Globex was in its infancy. Globex is the order matching system that trades the stock index futures like the E-mini S&P 500, E-mini NASDAQ. Those all trade on there. And now the Russell, since the CME created a Russell product to, replace the ICE Russell product. So when this happens, these fast market rules come into play. You're not guaranteed a fill. You're not even guaranteed a particular price. It's whatever. Sometimes the prices you see on your screen, like here, may not be the real price because the market's moving so fast. We've seen stutter tapes and all different types of tapes where the price seems to freeze, but it's not frozen. It's just moving so fast, and you have no idea what the price is. So back during those times, you had to get on the phone. We had to call down to the trading floor, get a price, and try our best to work it from there. Well, a similar thing happened today, but on a much smaller scale here in the stock index futures. This morning, a lot of you woke up and were surprised to see that the market was up. It was up pretty good. And what happened was I knew that at some short time after the 9:30 Eastern Standard Time, New York time open, that the markets would pull back or have a little bit of volatility. So I trailed the position and locked in as much profit as possible. For those of you who are new, I like to trade daily and weekly bars, meaning I'm not day trading. All right, I swing trade. I shoot for the moon. I shoot for the stars. A few ticks in it here and there is not going to cut it. That's not what I do. I'm not a day trader. I'm not a prisoner of the market. All right, so I like to move and shake. You know, I have a family, I have a life, so I can't just be chained to a computer screen all day. So what I do is I use the same alerts and the same things that you guys are using. I don't use anything different. We got the same readouts. So I'm going to show you exactly how this trade went down today. That's the whole purpose of this. We're gonna see how to use the sheet, the information on the sheet, to make money in these markets. One thing I will say, if you find yourself being a little gun shy or whatever, you have to trust the system. There's so much crazy stuff I could tell you about the system, but half of you wouldn't even believe me. So I don't really talk about it that much. I just let the system speak for itself. You will find there'll be times where markets will be consolidated, congested in a particular range and area. And there are going to be times where you may be in a trade for a couple of days and the market doesn't seem to really be moving. It may get close to hitting your stop and stopping you out if you're long. It may be close to stopping you out if you're short. But it doesn't. Your stops don't get hit, and you're just sitting there like, on pins and needles, wondering what's about to happen. I designed it so that a majority of the time you're going to be profitable. Yes, there are times where you're going to get stopped out at a loss, but those times should be few and far between. The majority of the time, you should be able to take some sort of a profit out of the market. So without further ado, let's jump into the E-mini NASDAQ 100 and peep this. I see I got a question already. Do you usually enter using the weekly and set your stops with the daily readouts? Okay, that's a good question. So I'm going to answer it. When I first started putting out the alerts, hence the title, the weekly post-wave price triggers, we used to do everything just based off of the weekly sheet, and you still can. But due to overwhelming response from subscribers, they wanted everything done daily. I used to just put out the sheet once a week. You would get it Sunday night for Monday, Tuesday, Wednesday, Thursday, Fridays for the whole week's trading. But for some people and their lifestyles, that just wasn't good enough. They wanted to be more active. So that's why we have the daily tab. So yes, to answer your question, I used to enter and exit solely used off the weekly tab, but now I use the daily. And one of the reasons too, and I'm glad I did kind of update things and make the daily tab there, is because the world that we live in now is changing so rapidly. Things change. Like God forbid, a nuke could go off in a major city today, and it would totally transform the market. You see now the Dow's up 400, it could be down 4,000 in an instant. Things happen fast. Yes, I am recording this. I am recording this. Yes, this is live. And the reason why I record our live training sessions is because not everybody's able to make it. People have jobs and other things. So I record it so that way if you're late coming in, you'll be able to get it. So I use the daily tab now mostly for my entries and exits, okay? And what I did is I put a lot of nuggets into it. On the daily tab, I used a lot of the weekly readings in the 52-week column, all right? When you're looking at that 52-week column, that, for the most part, is your weekly tab. All right, that is the entry price for the weekly tab. All right, so if I'm looking to enter a market long, but I want to do it based on the weekly reading, you can go and enter on the 52-week column on the daily tab. Use that as your entry. I like to also call it the conservative entry, if you will. Your 52-week is your conservative entry, conservative long entry into the market. The entry column is your standard entry on it. Yeah, I'm going to pull up the sheet in just a second. So that's how you're going to want to look at it. As far as what do you do once you get into the trade? You're in a trade, you're making money. What do you do? How do you determine? Like I said, there's no hard and fast rule, but we're going to go over some of it. We're going to go over some of it. You know the link that I dropped in the what's the word I'm looking at? The lose my train of thought. Okay, the link that I do in the mornings, most mornings anyway, that has the overnight information stuff on. Let me just show you. All right. Okay, if you come here to the blog, I drop a link every day. I used to just post it right in the trading room, but it's too long. So here it is. This is for today. All right, it gives you the overnight markets and news. All right, and then right here, if you scroll down, it's the U.S. stock preview. And this right here is the overnight U.S. stock movers, especially during earnings season. It's a long list. They're telling you different stocks, whatever. And then I have the market comments here. And you're going to see, you know, the first one right here is the E-mini S&P. This is the 10-year notes, the futures, U.S. dollar index futures, metals futures, and then the crude oil. And I added this today at the bottom. This is what we talked about yesterday in the trading room for those that missed it. This is at the bottom of the daily tab. So if you come on over to this right here, polscan.blogspot.com, you'll see it. Scroll down, you'll see it. And it's instructions, placing trades, and how to read the market. And it says, okay, so if you look at today's sheet, you will look for your buy-sell signals first. The buy-sell signal is located under the positive momentum and negative momentum columns. For buy signals, you're looking for either a 311, a 411, or a 911. Likewise for sell signals. Buy and sell are based on the positive momentum and negative momentum. There is also an 11, which means that the market is locked in with either bullish or bearish momentum. This is analogous to a continuation pattern in either direction. This is the main thrust of what we're going to be talking about today when I pull up the sheet. This is analogous to a continuation pattern in either direction. Next, you'll look at the trend column. Is where you have a buy signal as indicated above. Then you know that you will be trading with the trend. If there is a 3, 2, or a 1 in the trend column, 3 is a mature stage 3 trend. Everything is locked in momentum wise. A 2 is a stage 2 trend that is strengthening and will become a stage 3 soon. A 1 is the beginning stage of a trend that's developing. Next is the market timing, and that is where the price triggers come into play. For longs, you can enter at the entry column or take a more conservative approach if the 52-week column is greater than the entry column. It can be equal to or greater, it doesn't matter. And enter at the 52-week trigger. Once you have made your decision, you simply place the ticket and wait for the market to come to you. Then it says, note, there is a fail-safe built into the system. All right. Even without looking at the positive momentum and negative momentum columns, you can just use the price triggers themselves and enter a trade. I can't stress that enough. Reason being is because if the price trigger is hit, the market will move in a direction and take you along for the ride. All right. Exits. There are two ways to do exits. First, You can exit when the opposite price trigger is hit, and exits work like entry points. You let the market come to you. The more conservative approach is to use the stop loss column as your exit on long positions and use the entry column to exit on short positions. All right, now pulling up the sheet. Coming into today, this is what you would have seen. So we can make that bigger. Okay, here we go. Great. All right, let's put this here. Okay. So this is where I live at right here. The in play tab, the green one right here. This is where I stay at. This is my favorite tab because it's where I keep all the things that I personally am looking to trade. Okay. Got another question. If the price trigger is same as the 52-week high, does that mean anything? Yes, it does. And I'm about to get into that right now. All right, so coming into today, here is the mini NASDAQ 100 futures right here, the NQ. All right, this is what you've seen coming into today. All right, what is the first thing you notice? All right, you look at the entry column. All right, this entry column today was at 6856.66. There's no 0.66 in the futures. It trades in quarters. It trades at 0, 0, 25, 50, and 75. Okay, so you round this up to 75. So today's entry price in the E-mini NASDAQ 100 was 68.58. All right, it just so happened to coincide with the 52-week high right here. All right, your 52-week high right hither. They're the same. For those of you who've been with me the longest, you remember and recall that I told you that if the 52-week and the entry price are the same, it indicates a very strong move if those prices are triggered. It means a powerful move. Likewise, if the sell stop is the same price as the TRS sell short signal, and I take the TRS because I changed it to short sell, so I need to change that. But these two are the same also. So if the market were to crash and trigger the 66.51.5 sell short, that means a powerful move would be coming once that's triggered. The market's going to crash hard and fast. All right, so coming into today, where are your signals? Right here. First thing you look at is your positive momentum column and your negative momentum column. Under the positive momentum column, what do we have here on the NASDAQ? We have a rally alert. We got a 911. What trend are we in? Let's say you didn't know if the market was in an uptrend or a downtrend because you didn't have your chart in front of you. You can just go right over here where it says uptrend, column J, and downtrend, column L. All right, under the uptrend column on the NASDAQ 100, we got a 0. So the market's not in any type of uptrend, any shape or form, because this is a 0. You come over here, you see there's a -3 in the downtrend column, followed by a -11, which means that this market is in a mature stage 3 bear market, and the downside momentum is locked in. That's what it means. So now you know what you're doing. Today's trade is a counter trend trade. We're trading against the trend right now. The dangerous thing about trading against the trend is you don't know how long the rally will last. Will it be an intraday rally? Will it be a 1-day or 2-day rally? You just don't know. So you have to take what the market gives you, okay? So coming into today, how do you place this trade? What do you do? All right, I know I'm going to enter the market at 68.58 3/4. So I go into my broker's trading platform and I place an order to go long the E-mini NASDAQ at 1 contract or how many contracts you want to trade. And where do you put your stop? Your stop loss on every long position is the sell stop column. The sell stop column here is a dual column. It acts as the initial stop loss on a long position, and it also acts as your first sell point if you're selling short the market. All right, that's its dual purpose. Okay, so this is also equal to your sell short. So I'm sorry, sell stop column. It's also equal to the floor of the market that you are trading if you're in a bear market and you're trading with the trend. All right, your sell short is the resistance. Believe it or not, it's a resistance point. And when you're in a bear market and the market's trending down, usually the sell short number is going to be higher than the sell stop number. Okay, so that's the way that works. So today I'm putting my entry in to buy one E-mini NASDAQ. We're in the December contract, so one December E-mini NASDAQ, or one DECE, like we used to say on the trading desk. Buy a DECE, or it would say buy me a Christmas. Christmas cotton. Anything of a December contract was Christmas. So give me buy me one Christmas E-mini NASDAQ at 68.58.75 on a stop. And the stop is 66.51.5. Now, for those of you who are seasoned traders, you're probably looking at this right here and laughing. You probably fell out your chair laughing, especially those of you who come from the day trading realm. All right, you're laughing your behinds off. You're like, this dude is out of his mind. Look at that sell stop. You're risking 200 points on the E-mini NASDAQ. That's $4,000. You're risking $4,000. My goodness, I can't swing that. I know that's what most people are thinking. So let me explain this to you, why this is what it is. The reason this is what it is because I use what is called volatility stops. Volatility stops widen and narrow with the market. In times of high extreme volatility, you're going to see the range between these two prices widen. During times of very little volatility, you'll see these two numbers coming closer together. It's just how it is. All right. If you're undercapitalized, you shouldn't be trading futures anyway, at least not the E-minis. All right, moving on. Now, I will be the first to admit to you that I use a little trick. Now, the markets are volatile. Does that mean you stay out of the market? Of course not. All right, we're in this to make money. So scared money don't make no money. You either use this stop or you have to come up with another idea. That's what you do. For smaller accounts, you want to get in the market, you want to have at this, you want an opportunity to make that money. Let me show you what you do. Let me close this down. And now I'm about to show you how you pimp that. You ready? All right, let's pimp these markets. Come over here. All right, for those of you that have played Mortal Kombat, remember he says, get over here. But that's what we're doing. Get over here. All right, I'm gonna pull up this for, actually I don't need to, yeah, pull up the 1 hour chart. I want to show you a little something. At the time I put my trade on last night, you see this low right here? See this NASDAQ? See the low of the day on the E-mini NASDAQ? I used that as my initial stop. I put my stop a few ticks below this, so I put it at 68.16 even. All right? The overnight low had already been established, and I was comfortable with that. So I put my trade in to get long this at 68.58, and I use the 68.16 as my stop. Let me give you my rationale. My rationale is based on experience. Normally, when the markets are going to have rally days or crash days, the higher the low is already established shortly after the opening of the markets. Okay, so I knew that with that, that range, if the market were to take this out, that the rally alert was not going to be and played for this day. Instead, the market was ready to go back down again. Okay, so I used that as my stop loss. There's another way you could have done that too. You could have put a dollar stop. You could have said, well, you know what, I'm only comfortable risking, $100 or $200, whatever the number is, and you can use that as your stop. Say, okay, I'm going to enter, but I'm only going to give the market this much of a stop. Pros and cons of using dollar stops. The pro is you have more control of, managing your risk. You're saying I'm only willing to risk this much. All right, that's the pro. The con is setting dollar amount stops is not taking any account of market volatility. If you set your stop too close, there's a high chance you can get stopped out before the market moves in your favor, if it moves in your favor at all. That's why we don't do that. Okay, you have to use what the market gives you. If you're trading a highly volatile market, you have to use wider stops. There's no other way around it. Okay, so it's good to use what's on the sheet as your guide. All right, it's not saying you're going to keep your stop there forever. You're going to trail your position. Now let me show you how to do that. The 2-bar Charlie method is a technique that I developed in the 90s, and it's still viable to this day. It works very well. The 2-bar Charlie method is simple. You're looking at the 4-hour chart and the 1-hour chart. The 4-hour chart is the most conservative. The 1-hour chart is the most aggressive. What you're doing is you're looking at where the market is when you get in. So I placed my ticket when I got filled at the 68.58. When that triggered, I came over here and I looked at the market and said, okay, where are we? All right, we had that 68.16 was our support, right? So that's this bar right here. Everybody see that? That's this red bar right here. I'll move this cursor out the way so you can see. All right. So I put my stop below that low, knowing that if we take that out, the market's heading lower. So then I just watched the market go up. All right. And I said, okay, where am I going to get out at? I came over here and I looked at the 1-hour chart compared with the 4-hour chart. And I'm looking to see as the market's riding up. Okay, see the market riding up. All right. And I wait for the completion of the 1-hour bar to see how the market is going to move. I saw that the market was giving up a lot. It was jumping and skipping this morning. And it quickly allowed me to lock in a 1-point profit. So I moved my stop to lock in a 1-point profit. I was always giving the market anywhere from 30 to 50 points of wiggle room. All right, so the market could, do what it needed to do. And it got to a point where the market had now given me 2 full points. I'm sorry, yeah, one full point. And so I was like, okay, I'm not going to give that back. All right, what I always tell you, don't turn a winning trade into a losing trade. All right, take what you can, give nothing back. So the market allowed me to move that stop to 69.70, locking in a full point. I really wanted to get out at 70.01 after the market had hit. It was at 70.20 something. So I didn't get a chance to do that. The market did pull back. I figured if it triggered me and stopped me out, of course, I'm playing with the house's money. I'm still making a significant profit. But the issue is I wanted to last because I had an idea that the market was going to be pretty volatile, and it may even give me, another point or two. So I took out what I took out, and of course you're always going to leave money on the table. But that's how you do it. You use this. All right. So you look at your 1-hour chart. You see right now. Look at the lows of each bar. All right. On the 4-hour chart. This red bar is our bar. All right. We enter on that. We're looking for the next bar to enter. We didn't enter on that one. We enter the next one here. So you get triggered here, and now you're looking. You haven't done anything yet, so you got to wait. This bar finished, then this one came. All right. You got to see where's the market going to go. It looks like we're pulling back. Is it going to rally? It rallied and closed high. So then you come in here and now you can move your stop to right below the low of this bar, right above where you got in at. That's basically a break-even stop. You wait. Here's the next bar. Market's blowing up. All right, you can come in. You can move your stop to like the high of this bar, and then you come up here. Boom, break out again. And you do that on the 1 hour chart as well. So these little white dots, that's your parabolic SAR. You basically moving your stop there. You're just tracking with each bar. And when the market's done, like it did here, it pulls back and takes you out, stops you out. You got your profit. You're done for the day. So you can use the 4 hour chart, the most conservative one, to try to stay in the trade longer, or use the 1 hour chart to try to capture as much profit as possible. Another note is I like to get out and take profit at the end of each trading day. I don't always hold over unless we're like in a really good trend and the market's just starting. Then yeah, I'm gonna go ahead and hold. I'm gonna go ahead and rock that. Still gonna trail my position though. I'm gonna tighten my stop up so that I don't look like a dummy. You're always trying to trail your position as long as you can. And then sometimes too, if you get a bad feel, you're watching the order flow, you're reading the tape, and it's looking like the rally may be losing steam. Go ahead and move the stop as aggressive as you can, and try to take as much of the lion's share for the day as you can. For those of you that have jobs and stuff, you can't really do for so much. Another thing that you need to be aware of is that when you enter the market, you can also just say, okay, I'm going to get out on a close. You can do that too. All right, you can do market on close, and there are order types. Most brokers have the market on close. You can do that, or you can just check back the market when the close comes in, and just take profit that way. So you can, like I said, there's so many different nuances to taking profits and trailing a position. There's no right or wrong way per se. There's so many things you can do. What you really want to get in the habit of doing though is not being too greedy and allowing the market to move, to give it enough room. How you stop wide enough to give the market some room to move, but at the same token, you want to go ahead and trail your position as much as possible based on your abilities. If you're like me, you got a family, you got other things going on, you can't always just capture every penny, squeeze every penny out of the move, but you want to capture as much as possible. Like I told you at the beginning of this video, this training session, I'm trying to capture daily and weekly bars. I'm not trying to capture 5-minute, 15-minute bars. I'm trying to capture daily and weekly bars. All right, that's what we're here for. We're here to make this money. So I want to touch back on trading volatile markets. In a nutshell, how do you really trade a volatile market? You're looking at the sheet. Let's put the sheet back up. And you see that the stock coming into today for trading this NASDAQ was just too steep. All right. If that's the case for you, then don't use this. All right. Say, okay, I'm gonna give the market maybe a point. So instead of 66.51, you may put your stop at 67.51. Understand though, if you move your stop higher than this recommended stop, you run a high degree chance of getting stopped out. It is a rare occasion that you'll enter the market and get filled on the long and then get stopped out with these stops because they're volatility stops based on the market. Even when the markets narrow in, the probability of being stopped out on being tripped on both is rare. Normally, if you get tripped on both, that means that the fundamental technical dynamic in the market has changed. Another way to say it is there's an algo shift. The system is designed to take that into account, and it puts you on the right side of the market. So let's say I came into today, I took this trade, 68.58 and 3/4 before I went to bed last night, placed my trade, got filled, my stops in, I use the recommended stop. And then I wake up today and, oh no, I'm stopped out of my long. And I see the sell short got triggered. All right, notice how the sell short is the same price because I put in a stop and reverse. The market could be down, 500 points. You're like, oh my gosh, I just got destroyed on my long. Yeah, but you just made it all back on your short. That's the fail safe that I calculated into the system. So that if I'm stopped out on a long, I'm going to make it up on that short, and vice versa. If I'm stopped out on a short, I'm going to make it back on the long. There's so many dynamics that have been calculated into these price triggers. It's a phenomenon that, like I said, if I were to sit down and go over every nuance with you, most of you wouldn't even believe me. But just trust when I say that the price triggers are designed so that at the end you win, period. All right. Do I place stop and reverse on all my trades? No, to be honest with you, no, I don't. But if I do get stopped out on a trade, I will consider, getting in on the other side. So let's say when we got up today, it looked like this trade was not going to work out. The market wants to crash. I go ahead and put this trade on, then use this as my stop because that's how you're supposed to do it. On shorts, you come in, you look to enter the market here, and then you look to get out. Use this as your stop to trail the position. Now I'm going to show you something that very few people have ever seen. To be honest with you, something that nobody has seen. All right, just to give you a little idea of how the market works. All right, let's pull this up. All right, some of you have seen this, some of you have not. So we're gonna go. We're gonna look. We're gonna see what's what. All right. You see this white arrow right here? These yellow arrows right here? All right. What that means is those are your rally and crash alerts, all right? Let's go back some. Pick a point, any point. We'll pick any point, random, don't matter. I just go back. We're just doing anything. What's this? The TLT bonds. This was a rally alert right here. This is a rally alert right here. Rally alert right here. What did the market do after these rally alerts? It rallied. Crash alert right here. Market looked like it wanted to do something. Didn't do anything. If you would have came here, you would have got in the market, according to this, you would have got in the market somewhere around 123.14. When you got to here, market gave you just a little bit, whipsawed you, and then you would have been stopped out. But you would have been reversed along. Where would you have been stopped at? You would have been stopped at 125.13. So you would have lost about 2 points on this trade. But guess what? You would have been filled on this bar, and the market went as high as 128.92. Not only did you make your 2 points back, but the system gave you 2 more points in profit for your troubles. Then what did you get? You got a crash alert right here, followed by another crash alert right here. And then you got a third one right here. And then by the time you got here, it was like, look, man, this thing is about to fall. You got nothing but crash alerts coming. Had you just let those orders work, those crash alerts work, you'd have been filled up in here, and you would have been able to capture all this movement all the way down here to the 118 level. Almost 130 to 118 on an equity. That's a monster move. All right, this is just the TLT, the bonds. I'm just going back random. Don't matter what dates we go to. All right, here it didn't manifest. Here you did manifest. By the time you got here, look how that thing just spiked down. Got a rally alert here. Market told you it was topped. System said it's topped. Market fell. You can go anywhere. Doesn't matter. Pick a date. This tells you what's what. There's no way to, can't make this stuff up. System works. I put a lot of time and effort into building this. All right, this is 20 plus years of market research, trading the markets and things that I've learned and nuance and things I've seen since the 90s, you know. This is just the TLT. Let's look at another one. Here's another one for you. This right here is the Dow futures. See, I had the rally alert. If you look at your sheet today, you had a rally alert in that Dow. And look when we got these crash alerts since the market's been crashing. You had opportunities every day to catch this. All right. Even back here, could have caught all of that. Could have caught the rise up here. It's powerful. I can't stress to you how powerful the pulse waves are and how powerful they are at predicting turning points in the market. Look at this right here. Rally, you got your rally alert. Then the market says time to go. It went. Told you the bottom was in. It went. You can't make this up. Pull up another one. Take a look at silver. Now, for those of you who are not with me back in the go-go days of the gold and silver, remember 2011, late 2010, 2011, all of that, market was just going for it. It was doing whatever it had to do. It was making, making new highs, new lows, all that stuff. And people were like, oh my goodness. Well, let's see how far back I'm here. All right, this is back, even back here, 2013. Every time there's nuances in these markets, the system is sensitive and picks it up. I don't know what else to say in that. System is spectacular, to say the least. So doesn't matter what date you look at, don't matter. You can see what you would have been able to do if you were with me back during that time. You know, even if I pull up the weekly here, and this is the Russell futures, this is the new Russell futures contract. We can go all the way back. It warned you here that the market was getting ready to rally. Then you got here, said, okay, bear's coming, boom, it did. Then look at that rally. You can go anywhere you want. It tells you exactly what's what. Let's look at another example in today's sheet. That's another thing that I like about it too, is that if you look at these tabs, you can pull up and sort by alert. So let's say you just want to look at everything with the, you just want to look for these alerts right here. You want to start with your 911s. Come over here, pull it up. It'll bring you everything with a rally alert for the trading day. All right, it's all in here. All right, then you can just scroll down and see what's what. Hey, no problem, man. Go ahead. We're still recording. This will be up so you can see later. Don't worry about it. All right, see? So you can come up here, it's showing you everything. Everything in this tab, in this in play tab, is going to bring up and show you what's what. For those of you to trade equities or whatever. All right, it's telling you what to look for. You got these rally alerts. It has the ETFs, the equities, all that stuff. Anything you need to know is right here. You can just pull it up. All right, so I've rambled enough. Let's get into some of the questions on how to read this sheet and how to do these trades and manage these positions. Who wants to go first? What y'all got? Hit me with your questions. All right, I turned everybody's mics on. So if you want to talk, you can talk, or you can type it. No questions? Wow. I mean, I must have hit everything, huh? I must have answered everybody's questions. I try to be as thorough as possible. I try to predict what you're gonna ask me. So everybody is straight on what you're looking at. I mean, in a nutshell, this is, it's pretty simple, but basically in a nutshell, people, what you doing is you're just looking to see what kind of alerts you got, if any. Most of the time, you're gonna get 11s. All right, you're gonna get 11s. 11s just mean continuation. All right, if you're in an uptrend like this, you have a 3 here. All it means is a continuation. It's a continuation uptrend. If there was nothing here, then it means now it means new buying momentum is entering into like a bearish market. Like right here, as you can see, this the ultra short Nasdaq Biotech, ticker BIS today. It has a crash alert in it, but you're in a bull market with locked in momentum. So you trade with the trend. You can put the trade on, but just keep in mind that you might this stop may get triggered, and the market may reverse. So you may be able to make money on the long side and the short side. And it's a good idea to place both longs and shorts, just to be on the safe side. That way you don't have to try to chase the market. If one direction doesn't pan out, you make your money back on the secondary trade. And sometimes you can get lucky by doing that. I've been lucky many a time. I've gotten up to see that I'm long or short something, because what I do is I'll come in, especially the beginning of the week, I'll come over here to this column here, the 52 week, and I'll place entries. I'll place all the tickets, all my buy stops on here, because this is the conservative entry point. That way, if let's say I have to do something or I'm not watching that particular market, I come back, I can be triggered. I want to be triggered. That's the whole point of placing the ticket, and it's with the corresponding stop loss. So that's what I do. I always place my stop losses to go with my long positions. I don't just place the buy order. I place it with a stop loss, so that if this is triggered, please put my stop in the market, period. Same thing with my shorts. If I'm going to sell short, come in here, I'm going to put my sell short on. I'm going to place the corresponding stop loss of this too. Remember, the entry is not just your entry point for your longs, but it also acts as your stop loss on your shorts. Just remember that, okay? That's important. System is easy as pie, man. I did all the hard work. I did all the heavy lifting. All you gotta do is just come in, look for your alerts, and trade. It's better for you to have a handful of favorites, whether they be a combination of ETFs and futures or whatever. That way you don't have to try to scan every single thing. You want to get used to a particular market. It's really good just to have a handful of markets that you normally trade, because then you get used to the nuances of that particular market and how it moves. It's just a good idea. Okay, someone said, how have my trades been going for the crypto? Crypto's been acting the same way. Now, I am not actively trading crypto. I do not actively trade it for myself or for my clients. I do hold some crypto positions, but it's just something that I'm not trading it, I'm just holding. You know what I mean? I had a few cryptos that were gifted to me, I just hold them. I also am long the GBTC right here and the BTCS. I'm long that in my own personal account. I just bought and hold those. One day I do believe that they're going to explode higher, and so that's what that is. So can the momentum triggers be used as triggers? All right, that's a good question. Let's dig that real quick. All right, let me pull up the chart again. All right. Okay. So the question is, can the momentum triggers be used as entries? Yes, They can. Let's give a little background on the momentum triggers. Okay. The momentum trigger is a very advanced tool in your arsenal. Okay. And basically, it's your built-in stop runner. You're looking to see if the closing price is below the momentum trig, then you're going to buy the momentum trig. If the closing price is above the momentum trig, then you're going to sell. You're going to short the momentum trigger. All right, so that's how I did that. So yes, you can enter the market on the momentum trigger. Sometimes the momentum trigger price will equal either the entry price or the sell short price also. Sometimes they're the same. You just have to look and see if you find that. But yeah, you can enter on that. But I will be honest with you. Just using the momentum trig solely to enter. I mean, sorry, using the momentum trig to enter or exit the market, it can be done. It's just not as consistent as the entry trigger or the sell short trigger or the sell stop trigger or the 52-week trigger. But it can work, yes. All right, any recommendations on a good trading platform? I'm using Ameritrade now with $7 commissions per trade. Yeah, I'll be honest with you. I use TD Ameritrade Thinkorswim trading platform. I also use Interactive Brokers. I like those two companies. I've been trading with those two companies for a very long time. The commission really doesn't bother me that much. I'll be honest with you. Don't laugh too hard, but I don't even know what I'm paying in commissions right now with TD Ameritrade. I think it is the $7 or whatever. It really doesn't fade me because I'm trading enough shares to cover that. You know what I mean? Like the lowest amount of shares I'm trading on most stocks is 100 shares. For the really expensive stocks, I'll do like 10 shares. But because of the volatility, after I paid them their $7, I'm still walking away, in the green, strong in the green. So I don't really care about the commissions. Commissions only rip your face off and beat you, it only rips your pockets when you're losing. When you're losing and you start looking at the commissions, you're like, man, but commissions really don't, they're not a factor. This ain't the 1990s when it cost $150, sometimes $200 a trade to place a trade with a broker. Today's commissions are a joke compared to what they were in the 90s, all right? And even before then, where you didn't have the computer, you had to pick up a phone and literally speak to your broker and get them to place a trade for you. So $7 is not bad. The cheapest person in the world, from what I've seen, is Interactive Brokers. But the trade-off of that is you got to open an account with a minimum of 10,000. So if you got less than 10,000, then Interactive Brokers, you're not gonna be able to open an account there. But they have the 1 penny commission trades. Everything with Interactive is based on volume. They cater to your CTAs and hedge funds and stuff like that. So you can get with them, and if you have the funds, you can open an account there, and your commissions can be as low as a penny. But for most people, the TD Ameritrade Thinkorswim is suitable for most people. Okay, let's see. In a gap up situation, is it best to cancel your order and wait to see if the market falls below the trigger and re-enter then? Chasing gap seems like a fool's game. That's a very, very good question. It's a very good question. All right, trading the gap. I do believe I have a tutorial in the trading room folder files on trading the gap. Correct me if I'm wrong. If you don't find it, let me know. But let's just go ahead and address it now since we're here. All right, how to effectively trade the gap. Okay, first off, I designed this system to be able to absorb gaps. What do I mean by that? The system is designed so that if even if there is a gap in the market, okay, um, the system absorbs it. It knows how to get in the market, you know, long before there is a gapping situation. So normally you will be in the market and you won't be gapped. All right. I need to pull up the. Let's get back into the trading platform so you look at the chart and I can show you what I mean by that. All right. Then someone said, "What is a gap?" Okay, a gap is simply opening higher than where the market closed or opening lower than where the market closed. So case in point, I don't know if I can find one on here or not. But let's say yesterday the Dow closed at 10,000. And then today when the market opens, it opens up at 11,000. That's a 1,000 point gap up. All right, so that means it gapped up. So now the market at some point needs to fill that gap, meaning that prices need to fall down now, get closer to where the market gapped from. That's what it means by closing the gap. So I designed the system so that for the most part, you're not going to get gapped, especially if you're trading futures or Forex. If you're trading futures or Forex, you are probably never ever going to see a gap. Never, because the markets open at Sunday night, 6 p.m. Eastern Standard Time, and close Friday. So for the most part, you're always going to be in there before the breakouts move, and that's why I designed the system so that you can be ahead of the market. All right, my alerts go out before the market even moves in that direction. That's the whole point. However, trading equities, you don't have control over that. So you will see plenty of gaps when you trade equities, especially equities that do not have extended trading hours or pre-market trading. Okay, so it's better. And like you said, the weekly won't necessarily have a gap, but the daily you'll see it sometimes. That is correct. But remember what I said about using the weekly and daily tabs. If you use the 52-week price trigger, that's going to be the equivalent of your weekly trigger on the weekly tab. All right, so you can do that. Like I said, you could have came in. Let's pull it up. Let's go back to the sheet now. Let's pull it up. I'm gonna show you guys something. All right, so let's switch this. Okay, it's weekly. Okay, so coming to this week on the Russell futures. Okay, it told you to beware of the selling this market short at 1452.4, and you would have been looking to get long on the weekly around 1727, right? So basically, it's either short or nothing. You really don't have a fill coming into this week in this market. But if we go back a few weeks, let's go back here. All right, so the week of October the 19th, the market gave you a sell alert, sell signal, and said, okay, you're going to be looking to short this market at 1532, right? The market opened at 1541 and then proceeded to drop all the way down to 1457, right? So you wouldn't have had to worry about a gap because you would have placed the ticket right before the market opened, and then you would have caught that whole move for that week. Make sense? So that is an example, just one example. Okay. But trading equities is hard. It's hard to deal with that because you're going to have some equities that don't have extended trading hours or pre-market hours. So, a stock like Chipotle may close yesterday at $320 a share, and then when Wall Street opens today, it gaps up to 340. And you're like, man, I would like to have been long all of that. What in the world happened? And that's what it is. You got gapped. So now you got to wait for the market to pull back or whatever. Another way around the gap and to beat the gap is just to place the trades on a stop. I always enter the market on a stop. I always enter my markets on a buy stop or a sell stop. If the market gaps up above my buy stop, I do not care. Take me with you. I will hold that trade and ride that wave. 9 times out of 10, if I'm trading with the trend of the market, it's going to take me with it. It's going to gap that 20 points up, and chances are it ain't going to feel like that. It's going to keep running and give me my money before it even thinks about filling the gap. Does that make sense? Now, of course, that's an extreme example. Most gaps are not that severe. Most gaps are maybe $1 or $2 or something like that. They're not usually that enormous, but I have seen it where they are. You look at stocks like Google, you know, where it can move $70, $80, $100 on earnings announcements. Yeah, you can see that. So, but for the most part, though, you're not, like I said, that's why you want to develop a little portfolio, no more than 5 securities that you watch and trade every day. That way you'll be familiar with them, and 9 times out of 10, if a market gaps, you're already in the trade. You may have been in the trade a day or two before the gap occurs, and then the gap moves in your favor and gives you even more money than what you were looking for. So that's why I say you want to get in the habit of trading like no more than 5 things or less. That way, all of your trade, you're always going to be in the market. For the most part, that's how I designed the system. I'm always going to be long or short something, or at least have a ticket working to get into something. So remember that too. So to answer your question, is it better to wait on a gap? No, it's better to have your ticket working in the first place. That's why as soon as you get the alerts, you're supposed to be placing your tickets. You're supposed to be placing your tickets. Now, one thing I have learned for those of you that use interactive brokers, in case you don't know this, you have to check the box that says to allow for trade execution in extended hours, even if you're trading futures, or it won't execute until the bell rings at 9:30 the next day. And by that time, you could have missed the whole move. So get in the habit of placing your tickets. Don't wait for the market to move, because then you will be chasing the market. Just place the stops. If the market gaps, it's going to take you with it, but it's going to pay you. It's going to give you your money. Rarely have I seen a market explode and gap up higher only to crash and burn that day. You're hardly ever going to see something like that, or see a market gap down so huge and crash and then explode higher. No, you're not going to normally see that. That's not going to be the case. So for the most part, you're not going to see those kind of gaps. But you will see from time to time a little bit of gap. If a market gap's on you, chances are it's about to run for the next couple of days at least. So let the market take you with it. So you want to buy a stock. Let's say you're trading a $20 stock. You're going to buy it at $20.50 today. It gaps up and opens at $21. Big whoop. 50 cents ain't nothing. Go ahead and hold that trade. Put your stop in and let the market run. All right, that's a good way to do that. Any other questions? All right, let's see. Being a rookie and attempting to learn this system, what would be your top 3 markets to trade? You got some good questions today. I would stick with the ETFs. For example, follow the cursor. All right. I'm a futures man, so I always trade futures. I trade the Dow futures, the E-mini NASDAQ 100 futures, the E-mini S&P 500 futures, the Russell futures. Right here is gold futures, silver futures, crude oil futures, and natural gas futures. That's what I was bred and built on. So I would trade those futures, even as a rookie. Those are the markets I would trade. As far as equities are concerned, you got your diamonds, DIA, and the DXD, which is the inverse ETF of the Dow. You have your QQQ, and you have your QLD and QID, which is your ETFs for the NASDAQ 100 futures. The E-mini S&P futures is the ticker SPY or SSO or SDS, which is the inverse. Russell has IWM or UWM, and then the TWN is this inverse. Gold, if you want to trade, you can trade the gold futures or the micro mini gold futures, which is right here. The MGC is the micro mini gold futures. On the equity side, you have GLD, UGLD, and DGLD, which is the inverse ETF of the gold. Likewise of silver, trade the regular silver or the E-mini micro silver, which is ticker SIL. On the equity side of silver, SLV, USLV, or DSLV, which is the inverse ETF. Inverse ETF means that if you think the market's going down and you want to short it, instead of shorting the outright stocks, you can go in and buy the inverse ETF, which goes up as the market is falling. Here's your crude oil futures right here. On the equity side, you have XLE, you have DIG, DIG, or DUG, DUG, which is the inverse ETF. Natural gas has the UGAS or the DGAS, which is its inverse ETF. The US dollar has equities too. UP is the long, the dollar, and UDN is the short dollar. All right, so those are the markets I would be looking into if I was a rookie. So in other words, I would still be trading the same markets I trade now if I was a rookie. Okay, let's see. All right. Yep. Okay. Any other questions? Hey, I think it's cool, that you guys help each other out. That's what the trade room is for. It's traders from around the world coming together, helping each other to be successful. Because at the end of the day, I'm not successful until you all are successful. My job is to get every trader in the trading room consistently profitable. All right? Consistently profitable. That's my job. That's why I sweated and bled to make the system as easy to understand as possible so that would not be an issue. All right. Any other questions, comments, concerns? That's what I'm here for. Ask on, ask away. And let me see one other thing here, just to see. Okay, no, I thought we may have had some questions in the trading room. Okay, we don't. Oh, one other thing. Why I have this up, let's do this. I don't know what it looks like when you guys go into it, so I'm just going to go into it, all right? We're talking about the trading room files. Here we go. All right, so when you come to the trading room files, let me log in. I don't know if your page looks like mine. I don't know, but it should look something like this. All right, you come in. All right, the folders is right here. You should have a page that looks like this when you log in, I believe. You see, there's the weekly price triggers. For new people, the best place to start is, for new traders anyway, right here, the study course tab. This is the introduction to the price triggers. This is the technical analysis study course. And I would listen to the Trading Academy intro first. All right. Listen to this first, because this has a lot of nuggets and things of that nature, giving you the game of the markets. All right. So I would start right here, the Trading Academy. If you have not watched that video, you need to do yourself a favor and watch that video. And then over here we have the Black Ops Trading Premium Room files, and we have the Trading Room videos and YouTube documentaries and tutorials. If you click on the Black Ops Premium files, this has this whole bunch of like PDFs and stuff. A lot of it is outdated, though. I'm gonna have to update a lot of it. All right, so that's this one. Trading Room videos and YouTube documentaries. This has special stuff like the FOMC Live webinar. I put these in here because during the making of these, we had a lot of question and answer sessions and things of that nature, and just off the fly, some really off the fly stuff. So I put those in here for you, and I also put some of my documentaries like the Fed versus Bitcoin and central banks versus the blockchain. That's here. There is no collapse. This is the entire put into one file. This is that. This is the complete documentary. There is no collapse. That's in here. All right, and then we come over here and the tutorials folder. Some of you probably have never been to the tutorials folder. The tutorials folder has all of the tutorials that I've done on the system. Everything from how to set up your charts in Thinkorswim, how to short stocks, how to use the weekly pulse wave sheet like we just went over, order entry and order types, Trading Academy info. I put that back here too. This right here is a tutorial on how to enter orders on the O&A platform for those of you that trade the micro forex. Here's the 2-bar Charlie system revisited. And let's see. This right here is the 2-bar Charlie. This is the complete 60-minute 2-bar Charlie rule system breakout. This right here is a folder I made. It's just trading stocks. Okay. And this is Futures 101. You click Futures 101, and it has a whole bunch of the introduction on different things about futures and futures contracts and all that good stuff. Tons of stuff in here on that. Okay. And then here is the trading stocks. This is the trading stock options. As you can see here, I put a lot of stuff in here. Look at that. I blessed you with a bunch of books on trading options. All right, y'all see that? I put a bunch of books in here, PDF books on options trading. Okay? I blessed you with that. All right, so you have all that at your disposal. All right? Any questions on that? All right, so we good. Okay. Looks like the markets are trying to, nope, they're not rallying into the close. They're just holding on to the gains. Okay, so we could see a possible continuation pattern for tomorrow. See the daily chart right here on the NASDAQ 100, folks? It's looking like the market's having some problems hitting this resistance right here. You see it? Actually, I'm gonna have to do something here. Hold on, let me see. It's hard for me to remember how to do a lot of stuff I've done in here. Hold on, I gotta figure out how to. Okay, up here it is. Okay. All right, right here. See the magenta line right here? That's where it's about to hit some kind of resistance. All right, and then of course, if it gets enough power behind it, it's going to get back up to the longer term trend line resistance. You see that? And notice another thing here too. Let me pull this up. Let's get back to the weekly chart real quick. All right, you guys see that weekly chart? Basically, it's been like an even thing. It rallies up to the blue momentum line and then falls right back down. So it's a possibility we could be looking at more of the same, and prices could end up dropping below this Kumo cloud soon. That could be potentially very nasty. All right. Any other questions before we end this tutorial? Anybody? Did I miss a question from someone? All right, so we all good then. Everybody got the knowledge, wisdom, and understanding of what I was sharing today. All right, great. All right, thank you. I appreciate it. I appreciate it. Thanks for you guys' attention. All right, well, I'll see y'all over in the trading room. In the meantime, be encouraged. And remember, you guys, you can do this, man. It is rocket science, but it's not impossible. It can be done. You have all the tools at your disposal to do it. All right. So see y'all in the trading room, man. Peace.